Good afternoon, everyone. Thank you so much for your time on a Saturday afternoon. My name is Khaw, and I'm a portfolio manager at Nikko Asset Management. I manage the Asian REIT fund as well as other real estate portfolios. Well, hopefully my presentation today on REITs, Singapore REITs, will be worth your time and hopefully help you make some money as well. So for today's agenda, I'll be introducing Singapore REITs and why I think Singapore REITs are attractive at the moment. We will also be looking at the fundamental outlook of the REIT market, as well as to address the question at the top of investors' mind, which is what's the impact on REITs, what's the impact of interest rate hike in the US on REITs and real estate in Asia. But before I jump into my presentation on REITs, you might be wondering who Nikko Asset Management is. So allow me to give you a quick introduction of who we are. At Nikko Asset Management, we are one of the leading asset managers in Asia with more than $155 billion worth of asset under management. Even though we are owned by Sumitomo Trust, we are independently run, and our sole business is asset management. We also have a deep root in Singapore. Out of the 812 employees that we have in Singapore, about 120 are based here in Singapore. And perhaps of more relevance to the audience here today is that we manage about 13.6 billion worth of REIT AUM globally. So as mentioned previously, I manage the Asian REIT fund as well as real estate portfolios elsewhere. So how attractive are Singapore REITs exactly? Why as REITs? I'll suggest a few reasons why in the next few slides. I'll begin by putting Singapore REITs in the context of the fast-growing REIT market here in Asia, Japan, and Australia. The chart on the left shows us the market cap growth of Asian REITs over the last 10 to 12 years. As can be seen on the chart on the left, Singapore REITs are in the middle of one of the fastest growing REIT market in Asia and in the world. The growth rate we're looking at is about 52% per annum over the last 12 years. Although the history of Singapore REITs and Asian REITs in particular are still relatively quite short, I would say that the growth is tremendous. And the chart on the right shows us the growth of REITs in terms of numbers. So outside of Australia and Japan, we now have about 127 REITs across 5 Asian countries, as you can see on the chart on the right. So the total market cap of the sector now is just about $112 billion. So the first reason why we think REITs are attractive right now is the positive fundamental outlook. The diagram here gives us an idea of the outlook of various key property sectors across the REIT market. I would say that property fundamentals are generally good, with key sectors set to benefit in the short to medium term. From a physical market point of view, Singapore office and hotel sectors stand out. Rents in these sectors are set to benefit from decent growth due to favorable supply and demand dynamics. I will also note that even though retail and industrial will not be enjoying as strong a growth, they are still relatively defensive in nature, with passing rents expected to stay relatively firm or even increasing. I'll spend a bit more time later in my presentation to give you a more in-depth overview of all these sectors. The second reason why we think REITs are attractive at the moment is the access to prime real estate with attractive thematics. I'll say that even if you're extremely rich today, it will be quite hard for us to acquire good prime core real estate just because of the competitive acquisition landscape right now. And even if we can find that good asset, that core prime asset that we have, I'll say we still lack the expertise, know-how to manage all these assets. And this is where REITs are interesting, because they give us exposure to the best of class prime real estate in Asia, and not only that, all these assets will be managed by a capable professional management team, which I rate really highly. However, prime assets are only interesting if they have attractive stories. And there are several long-term themes that we are positive on at the moment. Firstly, as Asia grows, the financial hubs of Hong Kong and Singapore will become increasingly important. Through Singapore REITs, we will be getting exposure to the fast-growing financial hub that is in Singapore. The picture here shown is Ocean Financial Center and Marina Bay Financial Center. I'm sure a lot of us here would recognize them. Honestly, I think that these are some of the best office assets you can find anywhere across Asia. Another longer-term theme that we like is the growth of regional tourism. As emerging countries like Indonesia and China get more wealthy, the people's desire and ability to travel will only increase. So investors in hotel REITs would be effectively buying stakes in some of the best-known malls in Orchard Road, such as Mandarin Orchard, which is shown on the bottom right-hand corner. Hotels like these would benefit from the growth of regional tourism. There are also other growth asset classes with a story of their own. For example, Indian IT Park REITs would benefit from the multi-year infrastructure build-up, as well as the secular growth of the Indian economy under the new Prime Minister Narendra Modi. In addition, there's also a recent data center REIT IPO, which obviously has done really well. That will be a proxy for the growth of global data. Think the future growth of cloud computing, of e-commerce, etc. High dividend yield is another thing which I presume a lot of us would find extremely attractive. And S-REITs give us precisely that, with one of the highest dividend yield across the region. And this is the third reason why we think S-REITs are attractive. The top chart here compares the dividend yields of regional REITs with that of regional general equities, as well as REIT markets outside of the region. You can see that S-REITs have the highest dividend yield at about 6.1%, and Hong Kong REITs at 5.1%. The closest market then would be US REITs at 3.8%. The bottom chart compares the dividend yield spread of REITs over the respective local 10-year government bond yields. This chart shows that Singapore REITs have one of the highest yield spread across the global REIT universe. S-REITs are at 3.7%, and Hong Kong REITs are at 3.3%. And this brings me to my next point about valuations for REITs. So in this chart, which shows the dividend yield spread of Singapore REITs over time, compared to history, Singapore REITs are relatively inexpensive. The dividend yield spread is now about 3.7%, vis-a-vis the historical average yield spread of 3.2%. So what this means is that it gives us plenty of room for yield compression back to the historical average level, which is 3.2%, and hence more upside potential for investors. Now, this is one of the most important slides which I hope you'll take away with you today. If you were to forget everything that I've said today, that's fine, as long as you remember the content of this slide. So I understand a lot of us here are striving to be financially independent. So you'll be trying to hold a portfolio of equities and bonds in the hope that you can generate enough passive income to be financially free, to retire comfortably. Now, this is an efficient frontier chart. So what this is basically, efficient frontier is where rational investors would construct their equities and bond portfolios such that the risk and reward profile is located on this curve. So the vertical axis is the return, and the horizontal axis is the risk. So what this chart shows us is that when we add when we add Sing REITs to our portfolio of equities and bonds, our returns increase for the same amount of risk that we are taking. So what this chart tells us is that from an asset allocation angle, there is empirical evidence to demonstrate the benefits of having REITs in your portfolio. And in other words, buying REITs will improve your returns for the same amount of risk that you're taking. Next, Let us take a closer look at the fundamentals of S-REITs to see why we are so positive. Firstly, we are mildly positive on the office physical market. Rents are continuing to trend up as supply gets absorbed. As you can see in this graph, which shows the historical as well as the projected demand and supply dynamics of the Singapore office market. The blue bars are supply, yellow bars are demand, take up, and the pink line is the rental level. We can see that there is no supply in 2015. And even for the supply in 2016 and 2017, majority are in non-core CBD areas, and most of the supply in 2016 will only complete in the latter half of the year anyway. And from a longer term basis, which is where I'm coming from, while supply is going to pick up in 2016 and 2017 undeniably, the average supply over the next 5 years, so from now to 2020, the average supply is about 900,000 square feet, which in my opinion is absolutely manageable, given that the historical annual take-up is about 1 million square feet. In other words, demand outstrips supply. It is also pertinent to note that 2018 and to 2020 onwards is going to be a period of very tight supply given the lack of land tenders and redevelopments lately. So with near-term supply benign in this year, demand today will be driven by insurance and tech companies. And rents, I expect, should continue to grow for the next, at least the next 9 to 12 months. And in the recent results season, we saw that Capital Green reported pretty firm commitment. That's the new swanky office building in town. That's the latest one. So commitment rate is now about 76% from 69% in the prior quarter. Suntec REIT as well as Capital REIT have also reported pretty firm office occupancy. As it is, office rents have risen about 9.4% for the Grade A CBD office last year, and now vacancy is back down to 3.9%. So we expect this growth trend to continue into this year. Secondly, we expect a turnaround in hotel performance in Singapore on the back of a recovery in tourist arrivals. Of course, the first quarter operating numbers were still slightly weak due to the weak tourist arrival numbers. But I would say that a lot of negatives have been priced in. Tourist arrivals in the next few quarters should be underpinned by a few things. Some new cultural attractions, such as the new Singapore National Gallery, and also incremental additions to the annual sports events. We've already have F1, we've got the WTA Tennis Championship, and then next month we've got SEA Games. And subsequent to that, we have Rugby Sevens, which is going to be another big event. But apart from just cultural attractions and events, what would be tailwinds for the hotel REITs would be also cheaper oil price, so that people, it's cheaper for people to fly, or the weaker Sing dollar, as well as low base effect from last year. Hotel REITs were the underperformers last year. In particular, the Sing dollar effect is a factor that is not often highlighted enough. And this chart here in this slide captures that. This is a chart showing how the growth of tourist arrival, which is the blue line, how it correlates with the yellow line, which is the strength of the Sing dollar against a weighted regional currency basket. And this is weighted according to the mix of Singapore tourist arrivals in the prior quarter. As we can see, the correlation between the two lines is pretty high. And given the forecasted weakness of Sing dollar, there's a potential for tourist arrivals to rebound. Lastly, in the longer term, we have got the Singapore government behind us. The government is determined to make tourism one of the key growth pillars of the economy. You may have read recently about the relaxation of Chinese visas to Singapore, as well as maybe new tourist attraction in Mandai. And I've also mentioned previously, as emerging countries like Indonesia and China get more wealthy, then the people's ability and desire to travel would only increase. So in the long run, hotels in Singapore are primed to benefit from this long-term growth of regional tourism. Now, retail remains one of the most defensive asset classes and should also benefit from rising wages and recovery in tourist arrivals. In the near term, however, new supply in specific locations are placing a cap on spot rents. And the recent results season it's also quite encouraging to see that retail actually saw some improvement in operating numbers due to the stabilizing market, as well as the lower base. So the good news is that rental reversions have been maintained, so we are still signing rents above existing rents. But on the other hand, occupancy kind of moderated slightly, which was of some concern to some investors. Lately, there have also been some negative reports on retail tenants consolidating their space, rationalizing their space, so closing down some shops in some malls and then continuing operating in some malls. But so far, this problem has only been contained in a few problematic malls. So are retail malls in trouble? I would say that there are malls and there are malls, right? So two malls can be side by side next to each other, but one mall can perform much, much better than the other. A perfect example would be Illuma. I don't know how many of you remember that. So this is now known as Bugis Plus. It is right next to Bugis Junction. So for a long time, Illuma underperformed Bugis Junction persistently. And it was only until when Capital Malls Asia bought over the mall, did some asset enhancement initiatives, renovated the entire place, changed the tenant mix, changed the layout, that now the mall is performing much better than before. And if you look at the new incarnation which is Bugis Plus today, and you know how it looked like previously, that's the kind of management that I'm talking about. So the truth is professional management is extremely important, especially for retail malls. Tenant mix, layout, design, location, size of malls, all these are important ingredients for the success of a mall. And I think by and large, our listed retail REIT managers have been the leaders in this frontier. In the longer run, I believe that there will be a big bifurcation, a large diverging trend, if you like, of better managed malls by listed REITs performing much, much better than privately owned malls, which are maybe suboptimally managed. With regards to the industrial sector, I probably wouldn't elaborate as much since you just heard two industrial REIT presentations. But I would just like to highlight a few main points. And that is, the first being industrial rents are still comfortably above average passing rents, albeit there are some vacancy issues in some industrial subsectors. And this means that the dividend yields of industrial REITs are still very defensive and quite well protected. One thing that I like to do for my important Japanese institutional clients is that I'll bring them to see some of the assets here in Singapore. And picture shown here is one of Ascenda's assets in One North. And always come out of these tours thinking that, well, the quality of industrial assets in Singapore is really high. Lastly, the elephant in the room, the question at the top of investors' minds. What is the impact of interest rate hike on REITs, on real estate in general? The way I think about it right now is that the pace of monetary tightening in the US will be much slower than what the market is expecting. And we have to remember this is under the watch of a very dovish Fed chairwoman, Janet Yellen. Asymmetric rates will continue to keep the Fed on hold as long as possible. The thing is, if the Fed hikes rates too soon and the economy spirals down into a deflation, then the levers available to the Feds to resuscitate the economy will be very limited. But conversely, if they are slow to raise rates and inflation spikes, then they can easily raise rates and contain inflation. As it is right now, inflation prints in the US are in no danger of spiking, and it should be kept low due to the strong US dollar and low oil prices. Another important point which I would like to highlight is that there are now worries about global disinflation outside of the US. This means that even as the US reduces its treasury purchases, Europe and Japan have all taken up the baton and all aggressively expanding their balance sheet. And what this caused is that they've exerted a downward pressure on long bond yields, which is how REITs are valued. Apart from the Bank of Japan's surprise expansion of their government bond purchase program, China has eased aggressively as well. And of course, Europe has done their quantitative easing. So all of these will add to the liquidity pool in the region. With better visibility of the REIT and macro environment and yield outlook, we think that the spread between REIT yields and long bond yields can compress a little bit more. In this slide, what I'll highlight is that even if there's an increase in interest rates, it can actually be positive for REITs, for real estate. I'll say that again. Even if there's an increase in interest rates, it can actually be positive for REITs, depending, of course, on the pace of increase in interest rates, as well as why interest rates are increasing in the first place. If interest rates are only gradually rising, and the increase in inflationary pressure is due to an increase in economic activity, then I would say that this is positive for real estate, because the rental should catch up with a lag, and the cash flow and valuations of real estate should benefit as a result. REITs which have a shorter lease length can then take advantage of the situation. Although the marginal cost of financing may tick up slightly for REITs if rates go up, as REITs have generally used the opportunity of ultra low rates in the last few years to bring down the overall cost of financing, as well as to push up the duration of the debt book. So the impact of rising interest rates will therefore be spread out over many years. As can be seen on the pie chart on the bottom left, the debt duration of REITs are very dispersed. If you look at it, 49% of debt are only due in 2018 and beyond. And if you take a step further, 66% of debt are due in 2017 and beyond. So the pie chart on the bottom right shows us that REITs have slightly more than 70% of the debt book fixed or hedged. So even if short-term rates fluctuates, the impact felt by REITs will only be felt by in over many years. So this chart here shows us the average performance of REITs 3 months after every US Fed rate hike since June 1999. So the average performance of REITs 3 months after every rate hike. Right, so there have been about 23 Fed rate hikes since June 1999. The yellow bars here are the average performance of local equity markets in that period of time. The blue bars represent the REIT market average performance in the same period. And the pink bar represents the relative outperformance of REITs over general equities market. Now you may say conventional wisdom tells us that, suggests that higher interest rates is bad for real estate, bad for REITs. But what this graph here tells us is that even if interest rates increase, it can still be positive for REITs, which is very consistent with what I've said in the last 2 slides. And this is mainly due to the growth and visibility of their cash flow, as well as valuations of real estate. So in summary, to summarize and to wrap up my presentation, I think that REITs are attractive at the moment due to, number one, its positive real estate fundamentals. Number two, the exposure you can get to the best of class prime real estate in Asia with attractive stories, and of course managed by capable professional management team. 3, its high dividend yields. And number 4, its supportive valuations. While there are some people who may be concerned about the impact of US interest rate hike on REITs, I've explained that REITs can benefit even in an environment of rising interest rates. Thank you.